Welcome. Glad to be back here presenting to you in ITM Trading. Wow, what a great time to be a gold investor. I'm going to take you in, as usual with all our presentations, into the footprints in the sand, not what they say, but what they do. This is what we call following the money, and invariably, in my case, it involves charts, looking at how they are playing out. We'll start with the gold chart itself against the USD. But before we get into that, I'm going to mention that there's a couple of other pieces of data that have been very, very interesting. So as a short, I suppose, set the scene monologue, one of the things we'd like to point out is that the criteria for a recession was met in October 2023. And we got an absolute myriad of Janet Yellen response, financial press, media sympathy and response that said, you're actually not in a recession, even though we met the criteria for a recession. In other words, don't trust those stats, don't trust those stats. We have one set of stats, labor stats, that say there's still plenty of work being provided, and for that reason, you can't be in a recession if people are being hired at a robust rate. That was the narrative that was put to you for ignoring the fact that 2 quarters had already occurred, both with negative growth in the 2023 period. This is how they've brought you higher for longer, by denying what they haven't want to see, and that is a marked slowdown. In short, the global economy is very much reliant on regular 3-4 annual 4-year cycles of huge cash injections, leading to major pumps and surges in high risk on assets. We'll talk about Bitcoin as a comparable to gold in a minute as well. And then major losses of momentum and rolling into deep slumps. Not only is it a recession, I would suggest it's a full-blown slump that you're in. And in spite of that, gold moves higher. Gold moves higher because, for the simple reason that I will always put at the very, very forefront, you are participating in a global economy in a state of debt-based collapse. That's right, debt-based collapse. Why would one say that? Because the degree of proliferation, the degree that has been created as a result of these pump surges are such that their weight thereupon on the general economy is too much. Their valuations cannot be sustained. And we're seeing all forms of financial stress beginning to place great duress on the system as a result of a debt-based collapse. One of the charts I did want to show you that belongs to somebody else, the global market investors, are highlighting a very important aspect that is going on at the moment in the macroeconomy. And I'm setting the scene, just pointing out a few aspects of the macroeconomy before we go and have a look at those gold charts. In other words, I'm setting the stage in terms of all the props that need to be put around so that you know exactly where we're at on the map. So if we have a look at this particular chart is showing unrealized gains, or in brackets losses, and we are talking about losses here, on investment securities by FIDC, that is the financial deposit and investment scheme that actually backs or claims to back to make whole these particularly institutions that are FIDC-backed in the event of investors or clients actually losing their money. These unrealized losses, so these are open wounds that have yet to be closed, are on securities, and they are on securities, the variety of securities that are non-equity. Now, my biggest read on that is going to be invariably debt-related holdings. Unrealized losses on securities, solely reflecting the difference between the market value currently and the book value of those non-equity securities as of the quarter end. Non-equity securities, invariably, that would probably mean debt-based securities. So the current market value, deeply, deeply down versus what they were booked at when they were purchased and paid for. And these are unrealized losses. We've heard a lot about unrealized capital gains coming into interest by the likes of Kamala Harris and the Biden regime. It's quite interesting to actually see the degree of unrealized losses that are sitting. And you may actually find that you are in a situation where there are financial investment houses, banks that are holders, big holders of bonds and debt market assets that are deeply, deeply underwater. And this is not small, by the way. So I just want to highlight the 2008 crises in terms of valuation right there. And then we had the 2019 rolling into 2020 events there. And then you have a look at the scale. This is in billions. You're talking about 67.5% of the way to $1 trillion in losses for institutions. These are the ones that are being booked and owned up to. I never feel you get full disclosure in these forms of invariably surveys or accountant company reports. So this just highlights the degree that debt has gone down and the susceptibility to this in supposedly backed by the FIDC system financial institutions. So there are any number of reasons why we are awaiting, in our opinion, a kind of another to be categorized black swan event, although it will be pretty predictable based on the debt-based collapse that we are witnessing. And what we've actually seen is that the big long bonds actually have lost at one point from 2020 highs to not so long ago until the cuts started to get mooted. They have lost lost up to 45%. And the dollar had been relatively firm in the beginning of this year, Q1. What started to turn is, we say, the data comes in trends, and in actual fact, you saw the data starting to soften. And quite recently, you've since had the great labor, coming back to my original narrative of the labor market being the standalone reason why you are not in recession. You've seen multitude of payroll numbers that typically come out on Friday, the first Friday of a new month, that have been revised downwards over the last year since meeting the criteria for that recession after the fact, initially coming out hot and strong and boosting the market and quietly being revised downwards in retrospect. More interestingly is that in the last couple of weeks, we actually had a further adjustment to the downside of 818,000 jobs that were assumed to have been created but weren't actually over the last year. This is part and parcel of the birth-death model. When someone opens a company, people have a system that will assume immediately a secretary, a sales force are being hired. Sometimes corporations are owned just as an entity for ownership, and there can be actually zero hires that take place. So what we've now found is that the original narrative that both Powell and particularly Yellen and the financial media gave you over a year ago about the state of the United States economy is in fact false. And they have now admitted to varying degrees that the labor market is not nearly as warm or hot as they once said, as it is in fact now. And now the narrative has turned to interest rate cuts. So let's jump in and have a look at this gold chart and see what a beautiful structure this is. This is continuation patterns. I've jumped in on a 3-hourly just to show you the beauty of this particular. I'm recording this today. I typically record for you and the ITM guys, your best and local dealer to you in the United States of America, by the way, for securing your gold bullion. And long-standing family business with a very consultative approach, which I can't endorse more strongly. But on that point, 2,530 has been a sort of a capping lid for now. And you can see once again we are breaking to the upside and we are now trading above 2,550. This means the next logical number, 2,600, is closer than the 2,500 level, which you are being restrained from at roughly the $25,030. This is a significant breakout. And you can see under this, the buying is coming in on higher lows all the way with this flat lid. In fact, we call this a hunt volatility funnel structure. And I'll show you when I just unhook the eye here, how we draw that. And this, in a short term manner, is looking at least to another 2,575 on balance of probabilities, assuming continuation. There is no absolutes in markets, but on this relatively low time frame. And by the way, I'm not here to make you a low time frame trader. This is something we do in our community. In macro long scenarios where you are already an investor for the long haul, the opportunity in ongoing upside continuations is to use a tiny bit of leverage, get a little bit of a stop loss here, an entry here, and break to the upside. But of course, doing this helps you see very good moments before adding more physical investment gold to your portfolio. So understanding the chart is indeed very, very beneficial. And as I say, we look like we're going to have a run to the 2,575, 2,580, maybe before we have a little bit of a rest again. So let's talk about the fact if the economy is going to hit the buffers, because I've said a couple of things and I'm going to tell you a few more things as well. So on our Substack, under the Market Sniper that you'll find, we're actually highlighting a number of key economic events have occurred. A number have occurred. One of which occurred with this last unemployment number that came in on the Friday just past. That would be the September non-farm payrolls number, and that was the US 10-year minus the US 2-year yield chart. Now, some people will glaze over when you start talking about debt markets because they don't understand it. It's not an equity like Coca-Cola or Tesla. You see the product, you understand what it does. So I'll keep it short and brief. Basically, it's a difference in yield between a long-term debt instrument, 10 and beyond, 20 and 30, and a short-term debt instrument, usually issued by governments in this case, but there is also corporate debt when companies wish to borrow as well. The difference in the yield has been inverted, which tells you as a leading indicator, and we will go to the big time frame chart to show you that, tells you that you are going to have a crisis at some point. So when you have a yield curve inversion, it is nearly always, in fact, it's 100% track record that you will get a recession. And I would argue that you've already been in one for a while, so it's not so bad if you're surviving. This is not to misery you out. It's just to talk truth to where you are in the economic cycle. So I will go and fetch the bigger time frame chart for you to show you how that you do not necessarily get a yield curve inversion every recession, but every time you get a yield curve reversion, you definitely get a recession. So let's just have a look at that on the monthly side and have a look at this chart. So all these major macroeconomic events have, where there's been yield curve inversions, have resulted in substantial recessions thereafter. So you have the early 90s slump. The key thing about this, why do we care about this? Why are we talking about debt markets? Debt markets, no, they are more sensitive than equity markets. They are a leading market. So that's why if you don't want to understand them or learn about them, leave it to us, but trust us that they know better than stock markets. And they are bigger as well. They are very much bigger than all the global market caps of different equity markets across the world. The debt markets are substantially bigger. So you can see each orange box where you've had an inversion below the blue line has subsequently had a red box that makes this a leading indicator, unlike employment, which the Federal Reserve and Janet Yellen was using as a slow lagging indicator. The last thing you do is lay off your secretary. It costs you money. And you know that if the market turns, you have to rehire again and retrain. It's very disruptive to a business. So layoffs often come last. Price cuts and a lot of other things happen before you start cutting key staff. Here was the subprime crisis inversion. You can see when it hit subsequently. Here was an inversion during the period of June and then again in July that actually set up the repo market stress of September, October in the banking system that was a precursor to CV-19 and the pandemic events. So here you have another inversion, and this is of the modern era, that is that which I was showing you since 1980s. This is the largest, deepest, and longest inversion, and normally the greater the scale, the greater the eventual reaction. So here we go, we were breaking above the zero during the course of this month, and in fact it occurred during the course of this last week, and it was straight after the payrolls number. So when you revert back positive after inverting negative, that is when you're about to find out the name for your economic crisis. So you might be saying, Francis, you want me to buy gold and you're busy telling me there's an economic crisis that's going to escalate. Yes, I am. And the reason why I would say that to you is I'll be explaining, but it is many-fold. So with that understood, you're potentially likely to see a lot of disinflation or devaluation of assets during a potential crisis that is yet to be named, but is certainly coming. Could be an escalation in the war. We have many hot wars at the moment going on, although I'm not sure that it will necessarily be that one, because I'm going to talk about the oil price and what it tells you about gold in a minute. It could be banking related. It could be stage 2 of the yen carry trade coming unwind, which is something that occurred since I last updated you. We spoke in our Substack of the USD JPY being a fear indicator when that turns down. We spoke of copper selling off being a fear indicator when that turns down. Last time I appeared with you as well. Those two were mentioned, and we did mention the coming close to reverting of the yield curve pattern, which has now happened. What else is going on that is pointing to the economic crisis? And why is it a good thing to be investing in gold if there is an economic crisis? This over here is the SARM indicator, which is an employment indicator, and it illustrates recessions when unemployment is actually growing. You have broken this indicator too. I find it very amusing. This is the government statistics, how narrow the recession is that they drew for 2020 on account of unemployment. In actual fact, I would imagine most people felt that was a 2-year, 2.5-year, maybe even 3-year downside in terms of the market. So I wouldn't pay too much heed to the breadth of these lines. They probably understate the degree of economic crisis that followed, particularly when you look at the GFC over here. I would not have classified that as being over in 2009 before 2010. In fact, 10, 11, 12, 13 felt very hard and heavy work despite QE 1, 2, 3, which was supposedly masking and giving mildly positive non-recessional data on a devalued dollar, devalued pound, devalued euro, etc. So this indicator has also reverted. All of this points to a calamity in the wings waiting not far away. So what do? Well, overall, cash is your friend and gold is your friend. But some people will be saying right now as I speak, but hold on, Francis, gold went down during CV-19 and the pandemic, didn't it? And I would say, yes, indeed, sir, it did. But the interesting thing about gold in terms of that pandemic event, and I will bring that chart up for you over here, is that the period it went down, which was over here, that single candle during the month, it actually barely closed down for the month and ended up making a new high in short succession. If I pivot to the weekly chart, just to review that, you can see that actually gold was in an upward move, much like now, had a short, sharp sell-off, and ended up making further highs very quickly subsequently. This is on the weekly chart right here, right now. As a small reminder, while we are on this chart, we have given you targets of 2,900 as short-term targets and right the way up beyond 7.5 on larger time frames for this particular underlying. So don't forget, this is a macro trend, and I will be making the case that you have not really even yet begun. For those of you who are thinking that I'm late, look how much it's moved up. I could have had it at $1,100 way back in 18, and now it's $2,550. Let me just say to you, I will be showing you charts that will give you the impression that we have not even truly begun in this macro move that will be coming our way. I'm going to also take you to a far longer chart and just remind you, and this is something I'll keep putting in front of you, it's a great reminder to have. If we divide by the government's own stats, the CPI, which I do not trust, and I am almost convinced, as far as you can be without knowing, that they understate inflation, that the $800 value of the early 80s over here, when adjusted for inflation, you have not yet even got close to making a new high on that period, some better part of 50 years ago. That's right, early 80s to today, 20 plus 24. We're probably talking 45 years ago. You have not yet, on their statistics, made a new high in terms of this. And I will show you further charts that will point out that, in fact, you've barely begun. So let's get into some of those charts. What have I got over here for you to show? Well, I've already annotated it, so let me just take those annotations out just to stop bewildering you at first. What have I got here? It is a cross market, and I would say this is probably one of the most important charts I'm going to be showing you on gold. This is the precious metal king, the monetary metal in a debt collapse time. Remember, the debt collapsing is the fiat currency collapsing with it. They are borrowed into existence. The fiat is borrowed into existence. You have the debt asset. A bank is an issuer. Therefore, you become their asset because you are the holder of the debt. You borrowed it from them. They want you to pay it back with interest. So you have both the debt market and the fiat market in a state of varying collapse. However, it is synchronized and coordinated across other nations to be equally leveled of indebtedness, not perfectly so. Hence why we get the currency movements like we had on the USD JPY. But this is divided by the Dow Jones Industrial Index, the longest standing index of them all, that used to incorporate the railroads of way back, right the way through oil and all of the Rockefeller eras of America. And I've taken this chart right the way back to 1897. I think you'll agree that's a reasonable amount of history. The obvious standout spike is the bull market of January 1980 for gold. So what is the chart? It is gold divided by the Dow Jones. So the culture of equity seized us deeply. The proliferation of fiat and borrowing and America as the default currency for the world was the exorbitant privilege, let's say, has allowed a fiat proliferation to get to such an extreme that a monetized metal such as gold, which restricts the amount of spending due to the fact that you can't really get even 2% of new production a year, and gold in the ground ounces is heading ever lower for gold mining. ESG is causing boundaries for new mines to open. The bulk of explorations are being made by small cap companies, where bigger cap companies will later gobble them up for the ounces they have in the ground to try increase their net earnings by buying at a lower multiple these smaller players that have done all the lifting. These smaller players have very limited access to capital. It's getting harder to find all these aspects for gold, the monetary metal, and its unique properties being in play, seeing an ever-reducing supply of the precious metal inherently. This can't be mimicked by algorithmic mining for Bitcoin. It is an actual physical fact of production that is standing in your way. It is very difficult to overcome and requires lots of energy and work in an inflationary environment to build or break holes in the ground, to locate and to find and bring to the surface gold, the resource. But anyway, on a non-log, this is a regular chart scale. I'm going to now switch the lights on of my annotations and show you that there's a green zone and there's a red zone. This is a buy zone, think of it, and a point where you're getting super hot, and taking profits may not be a bad idea. And we are at the Dow Jones ratio down here of below 0.075. That's right, below 0.075. You're at almost, the biggest low was in the 1990s, 1967 actually, my apologies, 60s, and then lower still in the 90s. That was my original impression over there. 99 was peak low value gold to the equity market index, the Dow Jones. It is extreme low. Let me just mention that I've always stated that 2011 high was not even a bull run. That's right, you just heard me say it. In every metrics on cross market assessment, the run-up of 2011 was not even a full bull run. It was just a little blimp, a little bump off the lows. And you can see there is your 2011 highs for gold. You did not even get to the midway point between what is the 95% range for this ratio. In other words, only 5% is spent below and above the line, below the green and above the red. 95% zone, the middle, the most common area, the aggregate, I suppose, divided by the number of valuations. The halfway mark is at about 0.25. You are currently sitting at 0.062. 0.062. To get, if it call it 0.05, we've been there recently, you would have to go up 5 times in gold and the Dow standing still to just get somewhere in the midpoint. I'm going to put it to you that the overall debt collapse that will occur globally is going to be so vast it will make the Vietnam War overspend and the unfixing of the gold window and going full float of 1971 that Nixon did to turn out to be an absolute picnic in comparison to what we are due to face. In other words, I am probably the biggest gold bull out there. I think the spike and the disorderly nature that is going to follow for gold is going to be vast and could match or supersede the great events of 1980. And the equivalence in today's dollars in terms of price will stun many. I wouldn't even want to guess. You are so early that you have not even crossed back into the norm zone. You are still in that outer extremity to the downside, the green zone in gold versus Dow Jones index valuation. This could also be, it's important to say, a bear market for the stocks and indices. Remember, the bulk of Americans are stocks orientated. 401ks are stocks orientated. Most people are not holding any gold or gold shares. It's about as unpopular as can be thanks to BlackRock's ESG and climate change narratives that are deeply aggressive towards mining, permitting, and doing all forms of digging in the ground. This is an extreme low that I could see resetting violently. I also took this chart and did a draw because it is the key chart to this presentation in all aspects. And I did a little bit of drawing on it for you, just to give you an idea of how I interpret it in a screenshot. The Great Depression was when you ran in this yellow zone here to the extreme low. You turned and you were bought up super aggressively in gold, and you ran well through the upper extremity, and you went into, as events, World War II, which was a hyper extension of debt to win a war and become the productive nation, the dominant economy. America as dominant economy was assured during this period. The Marshall Plan was instituted on Britain. The borrowing was done by America, and Britain was end of empire post the 1933 and the 45 period that brought the end of the war, and America assumed quietly its superpower status. Here you have, and this is a new observation that is more common, that I started in the 67 through to 68, a super low volatility period. During 1967, taking us into the Vietnam War and the gold window, where you had super high valuation of the Dow relative to gold, super low valuation of gold in a very, very low volatility period. Low volatility is the precursor to a major high volatility event to the upside. And this is what occurred. We had the stagflation era of the 70s, with the peak rates of Volcker all the way in, that spiked you over there. Then we had the super low volatility again of the 1990s, and you can see it inching off the worst lows ever in gold to Dow Jones, that led to a minor kickback into the low end of the range that was 2011. This is really small beer. People were not substituting Dow Jones industrial stocks in any meaningful way for holding real monetized metals, because there still was not perceived to be a debt-based collapse. America was still getting away with spending more than it took in, and sending and exporting dollars to the producer nations of the world, such as Japan, China, South Korea, and others. However, we are now in the two small stages of super low volatility. We had a tiny little spike on the CV19 in the gold to Dow Jones index that still did not bring it even into the normalized range of over a century and a half. We're talking about the 1900s right the way through the 2000s, okay, a century and a quarter, that still haven't brought you back into that zone. The upside potential, if gold is to get back into the range or beyond the higher part of the range, which is when you're at around 0.45, 0.425 is where I've placed my top end. And by the way, you actually had a 1. You actually had a 1 valuation on the peak. That would mean the gold price would be equivalent to the Dow Jones valuation if you were to get a similar spike as to the 80s, and the events, the degree, the buying out of Europe, China, the rest of the world for gold, the dumping of equities, the loss of confidence in systems and paper, and digitization for physical metals could surpass anything you have ever seen before, in our opinion. And in our take as well, the yellow periods are the downturn, the depression, the Vietnam into gold window that set up the stagflation, the GFC, the subprime crisis, which was part and parcel of the lending unwind, occurred here, followed by the quantitative easing of 1, 2, and 3 that then drove the gold price somewhat back off its lows to where we are today. Now we are sitting awaiting a demand-destroying event that is yet to have a name. It could be the carry trade unwind going into second leg. It could be any of mainly downside shocks for which there are multiple, and your guess will be as good as mine. You could end up in a World War III, much like you had World War II after that. But right now, as far as things sit, I can see that the oil market does not seem to be reacting as expected. It is going down despite the possibility of all these hot wars. In fact, on this very aspect, as a trader, we actually have our community short oil, long gold as a retail trade. This is that same chart of gold against oil divided by oil. You will see the US oil here, and you can see we have a head and shoulder pattern, which is again pointing to gold going up, even against fellow commodities. So many people are commodity bulls, but the best commodity to have in a debt-based collapse is the monetary replacement, the original monetary system, that of precious metals. There is that head and shoulders, there is the break, the return move. This was 28 barrels was our neckline here, and since then you've shot up to 1 ounce of gold, securing you 36.9 barrels, and the target for this trade that we've been putting out for the last month in our community at themarketsniper.com is now got a potential return all the way up and beyond. Remember, this is a reversal, so we can surpass these gains substantially all the way up to the $60 mark up top here. As a beginning stage before having a rest and potentially going higher. Just to give you some semblance of big time frame view, how this has varied, you can see that at one point gold absolutely smoked oil completely during the period of the pandemic. A crushed consumer, a crushed retail, not traveling, the lockdowns, the business closures, all of that destroyed the oil price. We have 3 times called oil short in 2014, late 2019, to single digits, we said, and we are calling it short again at the moment today. The biggest beneficiary in the commodity complex relative to oil is there's your crushed consumer, there's your no travel, no movement, no deliveries of parcel, no purchases. We're seeing extremely high credit card debt. And with that debt problem, here's the other commodity, the monetary metal that is always trusted at the expense of a failing debt and fiat system. You couldn't have more polar opposite commodities during this period, and those that are overly positioned in energies could feel a real washout to the downside on this particular relationship. So we are seeing an inverted head and shoulders, part and parcel of a revisit, a redux of the CB19 event. In short, we could be getting something very similar. I hesitate to say same, it's always different, but a flush out in the energy stocks, particularly oil related. Why be in gold? Because it could sell off like COVID, you might ask. Well, I'll show you a couple of charts. This, and many people are, I'd like to have Bitcoin. If we're going to have all of this, let's be having Bitcoin. So what do I say to the Bitcoin versus gold argument and the whole notion of buying gold into a possible bad news environment? Well, Bitcoin last time in 2019 fell from a localized high of 10,500 to sub 4,000. That turned out to be 60% plus rout in Bitcoin. That is a shakeout many people cannot stomach. Forced sellers occur because at the same time you'll be losing your job, getting all your credit cards called in, getting all your debt cancelled. Everybody gets squeezed at the same time. Your rents go up, your interest bills go up sometimes, even though we are talking about a cycle of cuts. Everybody runs for cash. Everybody calls for cash on you at the wrong time. That's why people are forced sellers. It's easy to retrospectively say, I would have held through all of that and gone back up. Nothing but fear around you. People losing jobs, businesses shutting down, restaurateurs can't open. That was the stage that is set. People needed cash to meet basic ends. If you took it from the localized high, the further out high, that was 13,970. The downside beta was 72.93% to that low. That means if you had bought in at the high over there, you were talking about a 70% plus loss on that. It's hard to keep hanging on bad news over such an extended period as that time frame allowed. In fact, our concern here for the likes of Bitcoin, and we'll show you another chart here, is that it's a very similar environment. We are highlighting the broadening structures here and the demand destroying event. We know its name last time, and there it was. It's spilt. In short, the pattern is extending. That's what these lines are pointing out. The pattern is extending. We are so weak macroeconomically. Clearly, Bitcoin is struggling at the moment to make new highs, whilst gold is not. We can show you that Bitcoin versus gold chart as well. Similar type pattern with an upside move and a broadening structure. However, all the indicators say to a crashing economy. The Fed is always late and they're about to cut on their next September. People are arguing about 1 or 2 cuts. I can tell you it will not be enough to resurrect Bitcoin, to take it to its 145,000 target that many have seen and called from this head and shoulders reversal. You could find it gets a flush out to the downside on a macroeconomic event that could see it lose 20, maybe 30, maybe even up to 40% in a single spike low. At the same time, you will get money demand calls on your overdraft, your credit cards, and every other aspect of debt that you hold. You want to be a buyer in that moment because the solution is printing, and that's where you get your bull. Meantime, gold during these periods, as we saw on the yen carry trade, has proven that it is far stronger. This is gold. This is Bitcoin being divided by gold, and you can see that Bitcoin has been underperforming gold since March, and Bitcoin has also been underperforming the Nasdaq. It is positioned to the right of the tech stock market in terms of its risk, given the high volatility. In short, the market is not comfortable, apart from when the ETFs went ahead for BlackRock, which was when we got the bulk of this move. As the institutional dam wall broke, the cash was released, everybody who wanted to hold bought, and then what? Not enough new money. Gold is seen better. Tech stocks are being seen better. This is not the environment. The only thing that sees Bitcoin dominate again so strongly as it did then is proliferation post an event. Key quantitative easing and proliferation post the event. What should you carry into the event? Gold. How far did gold go down during the yen trade unwind that started on August the 2nd? I will show you that, and I will show you Bitcoin. Gold fell just a solitary 4.7%. We're going to take it to the daily, and I will show you the day that it happened. There is your August 2nd. I will measure from the absolute high of that candle to the absolute low, and you will see that the downside beta of gold was 4.57%. 4.57%, quickly back within a matter of days. So it made that low in 2 days, within another 2 days, 3 days, 4 days later, you were already back where you were, and in 5 and 6 days, you had made a new high. You had made a new high. In 5 and 6 days, you had made a new high. That is what gold did when the yen carry trade went down. Bitcoin fell from 70,000 to 48,000, a 30% drop. Going into a crash, you want something with a low downside beta that will automatically benefit from the cure to the upside. Bitcoin has both a high beta to the downside and a high beta to the upside, and you'll have to wait for a guaranteed super high quantity of quantitative easing. I'm not saying don't have some crypto. I'm saying go in holding 85%, 100% gold if comparing the two, and after or as quantitative easing is being announced or at the lows of any impending crash, put 15% into the much higher recovery beta of Bitcoin in the event of such a crash. Gold is your hold into a downside market because the crisis is debt-based and it finishes at a new high after any pullback. Its pullback will be lower in case you need it. You should keep some cash in case of a dash for cash during any crash, and you will be just fine. Only those that are over-indebted and exposed to high interest rates or call accounts, overdrafts that can be called in, will find themselves forced sellers. Try avoid being in that category. Excellent. I hope I've made a convincing case as to why we could have a very bumpy year end, and gold will be the best asset class for riding any downside and subsequent cure, which comes in the usual forms the cures do: interest rate cuts, liquidity provision, quantitative easing, and currency destruction, and ever greater expansion of a debt-failing system. Gold is your archway from the old system to the new, where you get to preserve your wealth. I also want to make a statement to you around ITM Trading, a great point of purchase for our American audience, which is all of you watching this today. Nationally local, I call it local. If you're in America, you are one big, beautiful country. Long-standing family business and a very consultative approach. It's not for the transaction, it's for having somebody you can talk to who'll give you updated intel, research, always have time for you on the phone, and with whom you can continue to build an ever-accumulating metal stack with confidence delivered to your door. So don't forget to give the guys a shout out and give them a try for your bullion purchasing needs. Thank you very much for watching. I'm the Market Sniper, Francis Hunt. I hope this video was insightful. Watch out for the downside. Be in the right assets, cash and gold. Until next time, I'll catch you later. Bye for now.